Welcome to TheoTrade. This is Don Kaufman. Here we are. It's April 19th, 2017. If you missed today's trading session, well, we hit our number once again in the S&P futures, 2349, and then reversed fairly harshly off of it. So 2349 literally was the high of the trading session. Backing off and closing, and this is the S&P futures here, right around 2333. But if you're curious what really caused the reversal today, it wasn't so much huge sell side activity, broadly throughout the S&P 500. In fact, if you look at the advanced decline line, frankly, the S&Ps, where did they end up today? All right, they're down like a whopping 3 points here. The advanced decline line, it didn't exactly get punished. Inside of the S&P 100, we had 66 decliners out there. Nevertheless, what really caused today's intraday reversal was, well, let's point fingers over here. It's oil. Oil did get pummeled on the trading session. You can see right here, a bit after, the cash markets open, some heavy sell side activity coming in. And again, this was actually sparked specifically from the energy report, the oil report that comes out on a weekly basis. So for those of you, if you do trade on an intraday basis, okay, I don't care whether you trade S&P futures, whether you trade Nasdaq futures, hey, you could be trading Microsoft for all that I care. It's incredibly important to know what major announcements could possibly impact broader markets during any given trading session. And here is a prime suspect, which is oil, that has what at the time appears to be a fairly mild announcement. Again, this is precisely 1 hour after the cash open, okay? And it's the petroleum status report. Okay, that's the official name out there. And it just sparks some sell side activity inside of oil. People are, again, looking to point specific fingers. Well, what it did is the sell side in oil took down the XLE, which is, of course, the energy sector itself. And again, on a broader chart, you can see this is a fairly substantial decline and starting to break through some fairly key levels here. Anything really through the 67 level, and right now we're closed here at 67.80 on the XLE. Anything under 67 is fairly dire in terms of the XLE. As you're looking at a 9-month chart, you haven't seen really much territory under the 67 level in the last 9 months. Looking at just a little bit of a broader take though on that, if I back up to 3 years, obviously oil seeing some tougher times when it was trading substantially lower, obviously, than $50 a barrel out there. So that's what really reversed markets on an intraday. But let's move on. Let's go a little bit past, today's kind of intraday reversal, because frankly, there were still some bright spots over here. The Nasdaq, although it reversed on an intraday basis, still pulling out some small gains over here, which, it made me start looking at the S&P versus the Nasdaq versus the Russell product over here. And I really started looking at this, again, a bit on a, not so much on an intraday basis, but what have these products really done thus far and kind of year to date? And I'm going to show you exactly why I'm looking at that here momentarily. So I pulled up the Qs, but I've got a specific style already set up in here. And what I'll do is I'll pull up the Qs versus the spiders versus the IWM, and you can see it on a percentage basis. Throughout the course of the year, I'll take, little tests and say like, okay, where are we at? For those of you that have never seen this before, it's just a comparison chart. Pretty straightforward. What we're looking at here on the top of your screen, again, this is the a year to date. On the top of the screen, it's the QQQ. Okay, all right, here in the middle is the spiders. Okay, last but definitely not least, IWM. And I wanted to just, take the temperature, if you will, of the marketplace midway, again, into April over here. Obviously, the Russell, relatively flat on the year. The spiders came off some of their best levels, being up, again, almost 7%, now up about 3.6%. And the Qs, all right, and again, this is where, if you're looking at this, you're like, so what? What can I do with it? This is where I see some opportunity, and it still resides inside of the Nasdaq there. I mean, the Nasdaq having returns of 10% thus far year to date. And again, I'm overall very, very bearish on markets. And I reiterate that day in and day out. I mean, you don't have to look much further than a handful of videos that we've done here at TheoTrade. You know, whether you want to look at the bonds, the volatility out there, you know, Don is bearish. But it's important to specify what products are really going to give you, if you will, the best risk reward. So having looked at this, so I'm looking at the Qs again, you know, the spiders and the IWM, it also caught my eye that if you haven't looked at the Dow, okay, in a while, and again, I'll kind of blank that. I mean, you also have to recognize the Dow has actually come from, you know, 21,100. It's actually threatening and could be threatening here very soon, the 20,000 level again. You know, it's not often that I talk about the Dow, and it's because I just do not like how the Dow is, you know, it's not market cap weighted. And what that means is, you know, like today, IBM had bad earnings or fell on its earnings, and that really impacts the Dow because it's a higher dollar stock. The previous day was Goldman Sachs. That's also one of the bigger, okay, dollar value stocks inside of the Dow, and that has a much broader impact. But again, very few people are talking about this, that the fact that the Dow has come off and they're like, oh, nobody's pointing a finger and saying, hey, wait a second, that's almost 1,000-point decline inside of the Dow. That's because we haven't really seen any big sell side activity hit markets. And that's exactly why it brings me right back once again into the Nasdaq, which has been completely unscathed thus far. And, you know, listen, I'm not saying run out and like, hey, short everything inside of the Nasdaq out there, because naked short position, that's not necessarily right for everybody. Okay, so you get a little bit more strategic if you're an options trader and just looking for, you know, a fairly straightforward trade. Listen, if you just want to go out there and have like a, you know, a risk a couple bucks to make a couple bucks over there, just go use 30 days out and buy something like an in-out spread. Okay, now if you want something a little bit more complicated, well, maybe I'll do that here on the weekend update. When I say, you know, go out and use something like an in-out spread, you can go out here and just buy a spread it's about $1 in the money, selling an option about $1 out of the money. Now, this happens to be a $3 wide spread that I just created. On a $3 wide spread, the most you can make is $3. What's the most you can lose? Well, it's pricing right now for about $1.20 debit. So why might I want to do a spread like this? Because in this particular spread, it already has, okay, the intrinsic value of the 133 puts. And for those of you, again, kind of uninitiated to what that intrinsic value really means, come down to options, theoreticals, and Greeks, and I'll show you intrinsic value. The real value, okay, the real value of these 133 puts happens to be $1.48. But you can go out right now and you can buy the spread for $1.20. Okay, this isn't like, oh, it's not about being a good deal. It's just the right strategic risk reward and the right strategic trade and probability. You know, very often when I go out there and I show buying a spread, immediately, you know, somebody might balk and say, no, I only want to sell spreads. I do not want to buy spreads. Well, you know, hey, listen, I get it. You know, I built most of my trading career surrounding selling spreads in the markets and just selling options in general. But frankly, listen, the implied volatilities, they're just too low. And this is an implied volatility percentile displaying that the Nasdaq, the Qs, okay, are still in one of their lowest kind of quadrants of volatility in the last, 52 weeks. And why do I want to sell myself into that kind of risk? I'd rather still be on the buy side of options, because when the moves have been coming lately, like if you looked at a market lately, okay, and when I say lately, I don't care whether you want to look at the Qs for 9 months, okay, or whether you want to look at the Nasdaq, for instance, for 3 years. The moves that come are violent ones. And for those of you that sell options premium, you don't want to be on the wrong side, okay, of a violent move, because there's just not going to be time to get out of it. And everybody convinces themselves of 50 different reasons it's okay, until you get run over like a freight train, okay, when you've sold something. So there are times where, yeah, no, I don't mind positioning myself, you know, to risk a buck to be able to make a buck, or in this case, risk $1.20, okay, to have some decent upside potential in a trade. Now, last but definitely not least, one other thing I want to give you here this evening and midweek, just a quick review in the SPX. So again, we know for the most part my feelings inside of not even the broader markets, but specific now to the Nasdaq, because the Nasdaq, clock is ticking on you there, Nasdaq. I mean, what's it going to take? Maybe a catalyst, somebody like Google coming out with bad earnings for everybody to realize that's it, the chicken is done, and the selling, then persists in the marketplace. Nevertheless, I want to give you a quick recap in the SPX because the expected moves lately have just been uncanny. And for that, we're going to go into Think Back, okay? All I'm doing right now is just taking you back, okay, to this weekend's data. Here we actually are going back, all right? Specifically, it's taking April 13th's trade data, although I've actually backed us up to this weekend, Sunday. But the last trading day, okay, of the previous week was April 13th. So why am I doing this? Because I wanted to show you the SPX closed last week at 2328, okay, 2328. So remember that number. As I open up this bar over here, where are we at right now? 2338. So we're precisely $10 higher, okay? However, I got to reiterate this. The market was expecting, as of the close last week, substantially more volatility, okay? This is between now and, Friday's open. We were looking for almost a $33 move, almost a $33 move higher or lower inside of the SPX. What do we have right now? Okay, it's good. It's good to know this. Why? Because we're through Wednesday right now, and yet we've really only had a 10-point move inside of the SPX. Now, granted, forget about everything that's happened to this point. It's neither here nor there. We haven't gotten anywhere near breaching our expected move for the entire week. Does that mean, though, that there's more volatility to possibly come as this week progresses? And frankly, if you look at markets right now, okay, so we'll come to the present here and we'll look at the exact same options. So instead of looking at them on Sunday, well, now we're looking at them live over here. They still have about $16 of expected move between now and Friday's open. So think about it. It's not a huge amount of volatility. Nevertheless, it's still a little bit alarming to see this much volatility packed in. Again, in comparison to what we've seen lately, okay, there's still quite a bit of volatility packed in for the remainder of this week. Stay tuned. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.